So I have a friend that just hit $500,000 in their investing portfolio, and he's a little concerned because about 28% of it is made up of one single stock, and that is Google. And he personally doesn't know if he should sell some of his Google stock in order to diversify his portfolio or if he should just keep it. Most finance experts recommend that no single stock should represent more than 5% of your total portfolio because being that concentrated opens you up for a volatility risk. Like if Google goes down 50% one year, it could drag your entire portfolio down with it. The problem is that if he sells his Google stock, he takes a tax hit. And additionally, if he's just diversifying to just exchange Google stock for stocks that he doesn't really even know that well, I don't think that's a great idea either. For higher net worth individuals, there is an option called an exchange fund. That's where you roll your concentrated stock positions into a diversified fund. And due to some IRS rules, you can actually defer and avoid some taxes altogether, but there is a 7-year lockup. I can make a separate video about that later. But for my friend, since he's still trying to build his wealth and has 30 plus years until retirement, I told him to start aiming to trim it down to about 20% of his portfolio. That's just a start. And then any additional money that he invests to not put it into Google stock so that over time, Google will represent less and less of his overall portfolio. In any case, profit is profit, even if it is taxed. But what are your thoughts? What would you do? Let me know in the comments.